Imagine a bank smashing profit forecasts in a competitive market, only to reveal underlying pressures on its earnings. That's the captivating reality unfolding with HDFC Bank's recent quarterly performance that leaves investors and analysts buzzing. But here's where it gets controversial. While the bank outperformed expectations, its lending margins tell a different story, sparking debates about the true health of India's banking sector. Could this be a sign of tougher times ahead despite the positive headlines? Let's dive in and unpack the details together. On October 18th, Mumbai-based private lender HDFC Bank, HDBK.NS, announced a standalone net profit of 186.4 billion Indian rupees. That's about $2.12 billion at current exchange rates for the 3 months ending September. This figure not only topped the previous year's 168.21 billion rupees but also exceeded analyst predictions, which hovered around 177.18 billion rupees based on data from LSEG. And this is the part most people miss. The bank's results were buoyed by robust loan growth and a surge in trading income, even as its core lending margins showed signs of strain. To clarify for beginners, net interest income, essentially the money banks earn from lending minus what they pay on deposits, climbed 4.8% to 315.5 billion rupees. However, the net interest margin, NIM, which measures how efficiently the bank is generating profit from its lending activities, dipped to 3.27% from 3.35% in the prior quarter. Why does this matter? Banks often adjust loan rates faster than deposit rates when central bank policies change, squeezing margins in the short term. But here's the intriguing twist. HDFC's Chief Financial Officer Srinivasan Vaidyanathan reassured shareholders during a conference call that margins are poised to rebound in the coming quarters as deposits are repriced, meaning the bank can gradually increase interest paid to depositors to reflect lower rates. Trading income added another layer of excitement, with net trading and mark-to-market gains soaring to 23.9 billion rupees, a massive leap from just 2.9 billion rupees in the same period last year. This highlights how savvy investment strategies can cushion financial results. But it also raises eyebrows. Is this volatility in trading a reliable pillar for long-term stability, or just a temporary boost? Loan growth was a standout, expanding 9.9% year-over-year, fueled by a resurgence in small and mid-sized business lending. Meanwhile, deposits grew 12% annually, a crucial win for the bank as it recovers from its merger with parent HDFC 2 years ago. Indian lenders have witnessed a gradual uptick in credit demand lately, following a sluggish phase, and experts anticipate a stronger recovery in the latter half of the fiscal year, thanks to recent government tax cuts. HDFC Bank CEO Sashidhar Jagdishan echoed this optimism, noting that economic activity has visibly accelerated post-tax cuts, directly fueling the bank's loan book expansion. The lender aims to match industry-wide loan growth this year and accelerate beyond that next year. Asset quality also shown, with the gross non-performing asset NPA ratio, the percentage of loans that are defaulting, improving to 1.24% by September's end, down from 1.4% 3 months prior. Provisions for bad loans and other potential losses jumped 29.6% to 35 billion rupees, a proactive move by the bank to create buffers against future risks, such as floating provisions for anticipated stressed assets. Over the past year, Indian banks have tightened lending standards and boosted provisions, especially amid challenges in retail sectors like personal loans and credit cards. This cautious approach is a double-edged sword. It strengthens resilience, but might slow growth in credit-dependent areas. $1 equals 87.9740 Indian rupees. Reported by Ashwin Manikandan and Ira Dougal. Edited by Ronajoy Mazumdar. Our standards, the Thomson Reuters Trust Principles. So, what do you think? Does HDFC Bank's profit beat signal a resilient banking giant? Or are these weak margins a red flag for broader economic pressures? And here's a controversial angle. Could the reliance on tax cuts for growth mean the recovery isn't as organic as it seems? Share your views in the comments. Agreement or disagreement welcome.